Welcome back to Global Stock Portfolios, and today we're going to look into geographical diversification. The contents of this presentation: after the introduction and an explanation what we do, we're going to look into existing markets, and we're going to also talk about exchange rates. And then we're going to really dig into this question of correlation between markets and what are the solutions for the individual investor. So what we do here at Global Stock Portfolio, we offer detailed portfolios for 13 stock markets in the world. And we allow you to diversify by buying stock directly. And we give you the name of these stocks, and we track the portfolios over the year. When you look at existing stock markets by market capitalization, you realize that the world of stock markets is rather small. In fact, we have a bunch of countries here that are very well known to us, but there's a lot of countries which are misrepresented, and I would say not represented at all. So, and especially Africa. So, well, we're talking of the large stock markets in the world, and definitely the United States is the first market in terms of market capitalization. And then we have several markets in Europe, and then we have Asia, Japan especially, and then China, South Korea, and Australia. So in the former slides, we've looked at existing stock markets through the national point of view. Now we're going to look into existing stock markets through stock exchanges, the real organizations who manage the trading itself. And stock exchanges are big organizations, but it's a strange situation because sometimes there can be 2 or 3 stock exchanges in only one country, and sometimes a stock exchange will cover several countries. In the US, there are 2 major stock exchanges, the New York Stock Exchange and NASDAQ, for only one country. But in Europe, we have one stock exchange, the London Stock Exchange, who covers both the UK and Italy, because they've taken over the organization of the stock market in Italy. And we have Euronext, which is an organization that covers trading in France, Belgium, and the Netherlands. So we have different situations, and we also have the case of China, where there are 3 major stock exchanges. So the existing stock markets can be ranked by market capitalization. Also, you have to take into consideration the exchange rate, and sometimes this rate changes during 1 year. And also, is it easy to invest from abroad into these existing stock markets? Sometimes it is, sometimes it's not, because of local rules. And to finish this slide, you have to remember that each country has a different taxation rule for dividends, and sometimes it steals a significant part of the dividend when you invest in a foreign country. So this has to be taken into consideration. On the other hand, the capital gain rules, usually they are your national capital gain rules. You don't borrow the foreign country capital gain taxation rule, so sometimes it's easier to understand. So what is correlation? Correlation measures the evolution of a market index with regards to another index. Correlation doesn't express a link of cause. It doesn't explain what is the reason between the link between those 2 series of data. There are several ways to calculate correlation. It can be calculated on a daily, weekly, monthly basis. Sometimes you have to take a 1-day lag into consideration, especially in Asia. And sometimes also you have to take into consideration other factors such as currency exchange and days off in different countries. Correlation figures can be quite surprising, but as a general conclusion, markets are very correlated. This is a correlation table of over 3 months on a daily basis of the various index covering the countries where we have our 13 portfolios. So these are in fact 14 indexes which are in this table. And what you see in this table is that over 3 months, where there are markets which are negatively correlated, and there are 3 of them that I would say stand out. This would be the Chinese market versus the rest of the stock exchanges, and it would be also, while the Turkish, which is the last column, the XU 100, which is the Turkish index, the XU 100 seems to be less correlated with the others, and maybe also the Israel index. Well, there are several indexes in Israel. This one is a general index, and it looks like it would be negatively correlated over 3 months with a majority of other indexes. On the other hand, a lot of the European indexes are quite correlated, and also they are correlated with the S&P 500. This is the correlation table over 1 year calculated on a weekly basis. And you see this is quite a change from what we've seen in the former slide. In fact, there's a lot of green, which means all these markets are positively correlated. And the figure which is in each of these cases, well, you see that some markets are correlated by more than 0.9, which means they are very correlated. Especially DAX and CAC 40, for example, but also DAX and FTSE 100, DAX with S&P 500. So you see a lot of developed countries' markets are very correlated. And in fact, the only one, there are 2 in this table which stand out. This is the Chinese market again, but still positively correlated with the rest of the world. And the Dutch, the AEX index, the Dutch market seems to be less correlated than the other markets too. This is a historical graph of correlation over the last century, and it's taken from a paper found online. What you can see in this graph is that in this table, well, the correlation has been going up, especially from the 70s till the years 2000, and while the correlation has reached a very high level between all stock markets. As we said before, correlation is just a measure of the way 2 sets of data change within time and respective to each other. They don't explain the link between those 2 series. In fact, markets are influenced by a flow of information coming from all kinds of sources: commodity markets, exchange rate markets, economic news, all kinds of data, statements made by different people. And what you can see, obviously, some markets are influences. They have a major influence on on how the other stock markets change over time. And then some markets are receivers of information and also influencers. They influence other markets at the same time. And this would be mostly, for example, the French, German, and the UK markets. And then some markets are receivers only. They are at the end of the chain and they don't influence any other market themselves. When you look into these changes, you can identify clusters, and there would be the Western Europe cluster, the American cluster. That means that the US and Canada move together. And there would be an Asian cluster also that it would be easy to identify. Some clusters have more influence than others, and it looks like the American cluster has a lot of influence on Western Europe and also on Asia on the next day. And also, why on the next day? Well, because Asia trades after the US, so that's why, and they don't have any overlap on trading hours. So this evolution of the market has to take place after the American market is closed. while it's not the same between the American market and the European markets, because when the American market opens at 9:30 local time, then it's 3:30 p.m. in continental Europe, and it means that all of a sudden they all only waiting for the result of the opening in the US, and that's where they take a market direction can change after 3:30 in the afternoon in Europe. In this correlation example these are France and Germany, you can see two very correlated markets on a daily basis, and it's over 5 years. But what you can see also, it doesn't mean, because two markets are very correlated, it doesn't mean that in the long run that they're not going to evolve separately. And in this case, we see that Germany behaves much better than France over 5 years, because the German economy behaves better than the French economy. So correlation, even very high correlation, doesn't mean that these markets won't have differences. This is another example with three major markets which are less correlated, and especially Japan is less correlated with the US and Germany. So you can see in red the Japanese evolution, although you can see that on a daily basis there can be a lot of correlation, but over more time, then you can see more differences. So, and over these last 5 years, Japan has behaved much better than these two other markets in the US and Germany, which is a surprise to most of investors. So, in terms of solutions for the individual investor, it means that index funds are not the solution, because, well, these index funds, you may think they're going to be a nice diversification, but in terms of correlation, they're just too correlated. They are very correlated, and their return is not very high. So what are you going to do with these index funds? So funds can be the solution if they beat the index consistently. The big question is, can investors beat the market consistently? Here's a list of famous economists and researchers that have dig into this question of investors beating the market. Eugene Fama, Robert Shiller, Richard Taylor, some of them are Nobel Prizes, and they've discussed this matter in great length. It looks like there are strategies that can be explored to beat the market, and among them, low PE, low price to book, earnings announcement, momentum, and timing, sell in May, are strategies that have been explored, and it looks like there are ways to beat the market following these strategies. So in principle, diversification is supposed to mitigate risk when you use negatively correlated markets. For example, if you take Germany and China as markets which are not exactly correlated and in the short term quite negatively correlated, then you have to check volatility and maximum drawdown. There are differences in volatilities between these markets, and the American market is much less volatile than the other markets. Especially those which are receiving information are much more volatile. One has to note that less volatility doesn't mean this market is not correlated with the others. And we have also the second factor, the maximum drawdown. So when you look at maximum drawdown, the American market has a smaller drawdown when the other markets have a bigger drawdown for the same events. So if you want to take less risk at this moment of crisis, then you'd better be invested in the US instead in the other markets. So as I said, you have to pick influencing markets to limit drawdown. And finally, you have to make a kind of balance between overpriced markets and limiting risk. Why is it so? It is because right now there are three markets which I consider as overpriced: China, the US, and Canada. I will explain in another presentation why I consider these markets as overpriced, but definitely I have to think twice. Do I need to invest in an overpriced market just to limit my risk? That's a good question, of course. So as an example of overpriced market, I gave China in the earlier slide. Although with our portfolio we've been beating the Shanghai index. The Shanghai index is up 4.2% this year. But when you take this value in euro, in fact, because the local currency has gone down versus the euro, the local index is a little bit down this year, minus 1%. And with our portfolio, we would have beaten this. We would have had a positive return, but still not very exciting. So you can question the need of diversifying a portfolio with an overpriced market. So this was the presentation for today. Thank you for your attention.